With sales up and listings down and prices, flat down in some areas, maybe slightly up in some areas, I often get the question, how is that happening? How are sales up, listings down, so it's tighter, but yet prices are still flat or, slightly declining? Stick around to the end and I'm going to explain why that happens. So June 2026, and this is the month the story starts to shift, it seems. Sales up 9.4% year over year, and that's the strongest monthly gain we've seen all year. New listings are still falling, and here's the number that caught my attention. On a month-over-month basis, prices actually moved up in June compared to May. Now, that's the first real, inflection signal in the market. I'm Anthony Malfara, Toronto real estate broker, co-team lead for the Property Boys. This is your June 2026 market breakdown. We're going to go through the GTA numbers, the city of Toronto. So let's start with the headline numbers. 6,770 homes sold across the GTA in June. That's up 9.4% compared to June of last year. The strongest year-over-year sales gain we've seen in 2026. So momentum seems to be building. New listings were 17,282, down 12.9% year over year. Listings are still falling even as demand rises. Active inventory sits at 27,329, down 13.5% from a year ago. Average price, $1,058,000 and change, down 3.9% from June. But here's what you don't see in that number. On a month-over-month seasonally adjusted basis, prices actually rose in June compared to May. So that's new. That's the first upward monthly price movement we've seen in this cycle. And TRREB is pointing to it as the beginning of the inflection. So the MLS Home Price Index, which gives you the like-for-like read on individual property values, is down 5.4% year over year. That's still a meaningful decline, but the rate of that decline has been narrowing every month. In March, it was closer to 7%. In June, it's 5.4%. So the direction is kind of clarifying here. TRREB called 2026 a year of two halves at the start of the year, and June is where that second half seems to begin. Their language this month, they expect accelerating transactions, more competition between buyers, and ultimately renewed price growth into year-end and 2027. Ongoing negotiating dynamics, average days on market is 29, sales to list ratio is 98%. Buyers still have room, but that room is continuously shrinking. Let me break this down by home type. Detached homes, 3,256 sold, up 9.1% from year over year. Average price 1.364, down only 2% from last year. The detached market is the most resilient segment in terms of both volume and price. Semi-detached, 617 sales. Average price of almost $1,031,000, down about 4.6% year over year. Modest volume growth, moderate price softness. Townhouses, there's 619 sales, average about $912,000, which is down 3.1% year over year. Holding up better than condos on the price side for sure. Condos were at 1,714 sales, about just over $630,000, down 9.5% year over year. So the condo volume is actually up 14.3%. So more buyers are moving at these prices, but values are still being tested. The condo market remains the most buyer-friendly segment, I would say. The key pattern as you move up the property ladder, condo to townhouse to detached, the price resilience improves. Ground-oriented homes in good locations are where sellers have the most leverage right now. So inside the city of Toronto, sales were at 2,443 in June, average price of about $1,081,000. The city's sale to new listing ratio trend is 37.4%, slightly above the GTA's at 36.5%, meaning the city is marginally tighter than the broader region. Toronto West had 627 sales, averaging $1,025,000. Toronto East, 592 at about $985,000. The sale to new list ratio is 102%, meaning homes there are actually selling above asking on average, which tells you there's real competition in that market right now. If you look at Toronto Central, 1,224 sales at an average of $1,157,000. Why are prices still falling? Supply down, demand up. Basic economics says prices should be rising. So, what's going on? And it's a great question. And the answer tells you more about where this market is actually headed than the headline numbers do. So let me walk you through that. So the key concept is this: sales volume and listing counts are leading indicators. Prices are a lagging indicator. They respond to conditions, but with a delay, sometimes months. And right now we're sitting in that delay window. Conditions are changing, prices just haven't caught up yet. So let's go through the reasons why this happens. So reason number one. First, the inventory picture is less tight than it looks on paper. Yes, active listings are down year over year, and that sounds meaningful, but the number of homes still available across the GTA is still quite substantial. In a genuinely tight market, that number is 10,000 to 12,000. The year-over-year comparison looks, good. The absolute level is still high. As long as buyers have real alternatives, they negotiate. And as long as buyers negotiate, sellers accept, right? That dynamic keeps prices moving, sideways or down even as the trend improves. So reason number two, the key market ratios haven't really crossed the threshold yet. The sales to new listing ratio is still below 40%, and that's technically a buyer's market. Months of inventory, depending where you are, was still in the mid fours. Prices typically don't start rising until that number falls below 4, and they don't accelerate until it's below 3. So, we're headed in the right direction, but we haven't crossed into seller's market territory yet. And until we do, sellers don't have the leverage to hold firm on price. Reason number three, sellers price based on recent comparables. And those comparables reflect, Q 2025 numbers and Q1 2026 numbers, a weaker market. Even as conditions get better today, it takes 3 to 6 months of, new transactions to shift expectations. Sellers need to see it happen around them before they have the confidence to hold their number. So reason number four, there's still a pipeline of sellers who are pricing to move, not to maximize. You have pre-construction, condo closings, investors carrying negative cash flow, assignment sales. Like, these transactions are happening at discounted prices, and they become the comps that set the ceiling for what everyone else can ask. Until that pipeline clears, it keeps downward pressure on the market. And reason number five, buyers are still cautious. Affordability is still an issue. The Bank of Canada has been cutting, but they held, but the 5-year fixed rates are still in that, low 4, maybe mid 4, depending on your qualification. And on $1 million property, that's still a significant monthly commitment. Although unemployment was better, it's still not great. There's still contraction in the market. Buyers haven't forgotten what happened in 2022, and so they're not rushing. So here's a framework I'd put around all of this. Tightening conditions are the ignition. Prices are the fire. So you turn the key, sales pick up, listings drop, but the engine still takes time to warm up. That's where it seems we are right now. Like, the ignition is on, the fire might be coming. TRREB is forecasting, a better second half, and leading to, price recovery in 2027, which means the most important window isn't when prices are rising. It's probably right now, in that gap between the signal and the outcome. Because by the time recovery is visible, the opportunity is gone. And that's not intended to rush anybody. It's just kind of the way it works. So if you live in the GTA and you want a straight read on, what your home is worth or where the opportunity is as a buyer right now, reach out. DMs are open. Link is in the bio. I'm in the GTA every single day.